Welcome to Yahoo Finance UnCut. I am your host, Jared Blikre, and we have with us today David Keller. He is a Chief Market Strategist at StockCharts. And Dave, it's a pleasure to be with you. We had the opportunity to do an event with Fidelity, a webinar earlier this year with a bunch of our compatriots. It was a lot of fun. And you're here today, and we're just gonna duke it out here for 15 minutes. Well, we're gonna duke it out with the markets apparently, because they've been beating up a lot of people recently, and
maybe just more licking our wounds, I guess, right?
Ooh, it's been rough this year. 60-40. Are we seeing it go? Are we seeing the death knell here? We're going to talk about that. And let's start out with the current market environment. I do like to get your take on what's been going on now. And just a quick note to our guests: this is taped. We're going to be showing this for a few weeks on our live program, so references are to the recent past, but not necessarily what happened this morning. So, Dave, as we sit here, we are at new lows. The Dow just dropped into bear market territory. I was looking at my watch, and I didn't know that we were in a bear market until this happened. What are you seeing right now?
Yeah, arbitrary 20% moves aside.
Don't even start.
It's all. I mean, it's all about the trend, right? And I mean, this game, I would argue, is never easy, but there are times when it seems a little more straightforward than other times. You know, if you followed over the last 2 years the simple market maxim of don't fight the Fed, I think you pretty much overall were on the right side of things in 2021 and probably made the rotation in 2022 pretty seamlessly, right? 2021 was a liquidity-driven bull market with the Fed injecting money in the system, risk assets go higher. All of that changes in 2022, and you can see from how the charts evolve, from stocks making consistent new highs to stocks making consistent swing lows. Sectors like communication services, just, you know, brilliant moves for 1 year and then struggling mightily the next. So I think the story of 2022 has been about the Fed being much less accommodative, now quantitative tightening that we're dealing with. Overall, just the trends being much more in a risk-off fashion, and that's driven by a strong dollar and it's driven by higher rates. Those two trends appear very much in place. The US dollar making a new high again this week. Interest rates, 10-year yield making a new high again this week. So as long as those things keep happening, I would not be looking for some great, you know, reversal in the equity markets. However, if your runway is long enough, and this is what I keep reminding some of our own users who are long-term investors, if your runway is long enough, you have the opportunity to get into pretty decent companies at a 20, 30, 40% discount. That's not too bad. Again, as long as you have the time and the risk management to be able to deal with any sort of hiccups along the way. But eventually we may look back at one of the great buying opportunities for equities.
That's what it usually looks like with 2020 hindsight. But I'll tell you what, Dave, when the market's down 20%, I'm thinking, wow, it could go down another 100%. And I think a lot of people are thinking the same thing, especially people who started buying the dip in January on the advice of people like Dr. Marko Kolanovic, you know, some of these great quant minds who did so well over the last 10 years in a very different regime where we had low interest rates, perpetually low. Now things are a bit different. And we always knew that we weren't supposed to fight the Fed, but nevertheless, Jerome Powell has to remind us every few weeks, hi, we're here, we're hiking until something breaks. Kind of outline the thinking that it requires for a major mind shift as we are experiencing right now from an old regime to a new regime, because that can take time here.
Yeah, no, it's a really good question. And I think the crowd, if there's a cohort of investors that have probably been hurt the most, it's the buy on the dips crowd. Because talk about the perfect way to play 2021. It was very straightforward. And even using just a simple moving average approach and just looking for when we pull back was a really good time to just keep scaling into these names. Greg Morris, who is a mentor of mine, wrote a number of books in technical analysis, always used to say that all new highs are bullish except the last one. And I think that is, you know, where a lot of people struggle, right? The financial industry is fantastic about finding something that works and then driving that into the ground way past the point when it's actually profitable. And I think that's what you saw 2021 into 2022, right? Besides the macro conditions and how the Fed was, you know, I think clearly telegraphed their intention to change their policy, the reality of what that actually meant, the reality of risk assets just rolling over and just materially finding new lows consistently, uptrends that felt so persistent and so consistent, reversing, I think was a tough pill for a lot of investors to swallow, particularly a whole group of new investors who had never and still have never really experienced a deep, painful bear market. I immediately went back to the 2008-2009 playbook, the 2000 to 2002 playbook. look like I'm even just, I mean, lesser ones, right? Like 2014, 15, like I'm going back to, okay, how did that feel? What sense did I get? What did the charts do? What does this moment remind me of the most? And for me, I think for a lot of 2022, it's felt a lot less like sort of your average bull market year. And it's felt a lot more like 2008 did, which was coming off of a new all-time high, but then seeing how quickly the technical configurations could change and the sentiment could get so bearish, which is what we're facing now today in September.
I think that's an excellent point. A lot of people are just trading the last bear market or their first bear market. And for all intents and purposes, I think the pandemic bear market that we had in 2020 almost doesn't count because it was so quick. I was worried about washing my groceries and it just kind of blew over my head that I was supposed to do anything else. But seriously, you went back to that 2008, 2009 example. I think there are very good historical analogs here. And also 2000 to 2002, that is, these bear markets tend to take time to play out a lot longer than the buy the dip crowd has been accustomed to experiencing over the last decade plus. And you also have an interesting anecdote I'd love to hear about. You were writing about this recently where you were charting 2008. And I remember in December, I think it was, we broke to new lows. Everybody thought the low was in place and we broke to new lows. And what happened then?
So what's funny, at the time I was at Fidelity, and the Fidelity chart room is a legendary space devoted to market history. And it's been at the Fidelity firm for over 50, 60 years probably at this point. But still, although we had a lot of digital signage, a lot of really cool new technology, still were wall-sized paper charts that dominated this space. And it was so beautiful to see these the market history visually and go back 100, 200 years and really think about how risk assets had evolved over time. In 2008, 2009, one of the great moments that I found was, when you have a big wall-sized paper chart, every once in a while, the market will move so severely that you literally have to rescale the whole space. And the last time it had happened was in 1983. If you know your market history, that's when the Dow finally broke above 1,000, hit 1,000 in the late 60s. Most of the 70s kept bouncing against there. And then finally, 1983, after the 82 low, broke to new highs. And at that moment, the market literally went through the roof of the chart room because it went off the paper. They had to rescale everything to be able to accommodate the new data.
The power of Blikre, by the way, I would add, there's a lot of talk about Blikre, so some parallels we can get into, but back to your story.
Interesting historical parallel, right? And then in 2008, 2009, we had the exact opposite issue, which was the market came down so severely and so significantly that we had to reprint out the entire wall to accommodate for the much lower price action. So we come in one day and the chart room team is literally pulling these huge wall-sized papers and printing out brand new ones. And we're all sitting there thinking, this probably is a signal of some sort that we have to rescale the entire space. And sure enough, it was soon after that we got into that sort of first, second quarter of 2009, the bottoming period, the financials leading out of the lows. And so when I find that there's such severe movements that you have to sort of rescale your thinking, it tells you it's such a significant move that I often tell people just step away from your monitors a couple steps, really think about the big picture. And I think with interest rates, with equities at this moment, it's probably a really good approach.
And not to mention foreign exchange as well, because we've seen that. I mean, there seems to be a rotation. I think it was equities that kind of started sneezing. Bonds definitely caught a cold, if not COVID. And then foreign currencies a little bit late to the game. Looks like we might have a major unwind. Saw a mini flash crash in the British pound recently. Just wondering how you're approaching some of these markets right now, because I noticed, I think it was back in 2008, 2009, it was when the bond market really unraveled and those highly leveraged trades, they were centered at the big banks back then. Finally, that was the market clearing event that we needed to get on a firmer footing. But it took QE1 way back in the day. I think it was March of 2009 that Bernanke finally announced that. What are we going to expect this time? Everybody's expecting the Fed to pivot. Jerome Powell says not going to happen until we actually see the data. People haven't listened so far. Maybe they will, but what is it going to take this time?
It's a really good question, Jared. And I think you hit on it at the end of your question. People haven't been listening so far. And there's a behavioral bias called confirmation bias, which runs rampant in the financial industry, particularly with investors. And what that is basically you decide whether you're bullish or bearish, and essentially, and then you start gathering information. And anything that backs up your pre-decision of your bias, you sort of attribute greater value. Anything that disagrees with your thesis, you kind of mentally push it away. I think that's what prevented any investors that haven't gotten defensive in a significant enough way so far in 2022 have probably fallen victim in some way to that confirmation bias. You feel in your body that equities are going to go higher, so you look with disbelief as the market actually continues to go lower. What happens during a bear market is eventually you get to what I'd call the acceptance phase, which is when investors actually recognize the market has been going down. And believe it or not, even in June, July, August, when we're getting a little bounce off of the lows, I'm getting people all bulled up, calling the bottom, saying that's it. Obviously, it's over. But what you have to remember in your previous comment, Jared, you mentioned the recessionary environment, right? And an inverted yield curve, which is very much where we're at right now. One of the best predictors of a prolonged bear market experience is an inverted yield curve. We're there. I think down the road, we'll look back and make it, it'll be very clear that this was a recessionary period. And if that's the case, bear markets tend to be longer, both in terms of price deterioration and in terms of time duration. So I think the process of the bear market, the process of the bottoming out is what's going to be a challenge. And I think, what are you looking for? You look at the bond markets, right? As long as interest rates keep going higher, it's hard for me to imagine our growth-oriented benchmarks mounting any sort of significant recovery. I think you could see bounces like you saw in June and July, absolutely. But in terms of really materially changing the trend in the market, that has to wait for the Fed to change their song, and that isn't reflected in the markets until bonds start to rally. So I'd be looking at the TLT, I'd be looking at interest rates, and seeing when you get some reversal there. I would imagine that equities probably react to that.
It's amazing how far the bond market has come so quickly. The bonds sinking in price, yields rising. I want to get to that in a second. You mentioned that we are in the acceptance phase. I did have to look up the 5 stages of grief in order, and this has to do maybe with a different context, but they are denial, anger, bargaining, going to happen again, right? Depression, and then finally acceptance. So maybe we are in the final stages here according to behavioral psychology, but let's go back to the charts and the markets here. I was looking at the 30-year. The futures are at, what, 124 TLT. I don't know the exact price here. They've come so far. I really want to punt this, and not necessarily on a long-term basis, but let's say that we are seeing signs of reversal in the bond market. You mentioned before towards the beginning of the program about investors being able to dip their toes in the water because stocks are cheap. What are you looking at right now in terms of opportunities from the charts that you like?
It's a really good question. I think one of my great learning experiences in my career, I moved from New York up to Boston in 2008. I joined Fidelity as a director of research. And so I had a chance to see and experience the financial crisis with some really seasoned investors, people like Will Danoff and Joel Tillinghast and Bruce Johnstone and some really successful investors. And what I found is they were really happy as the market was going down. They were not happy because their shareholders were losing, part of their investment. That was not comfortable. But what they were excited about was the future. They were looking down the road and saying, listen, this is an opportunity to buy great companies at a discount. This is a rare opportunity, and this is something I'm excited about. Sure enough, I mean, if you zoom out enough, what a great time to be buying stocks, right? As you're going in the first quarter of 2009. Tough to do it in the moment, but if you're long-term as an investor, and if your runway's long enough, you can do okay with that. What I would always tell people is there are often career-busting moves along the way, though, and that's where it can be challenging, right? It's not easy to just buy and close your eyes and hope that things go well over the next couple years. Here's what tends to happen if we are in sort of that acceptance phase. There are a couple ways we can measure sentiment. One of them is with the AAII survey. That's the American Association of Individual Investors. It's a weekly survey. It has its issues, as any survey data might, but it's a great long-term data set. And if you compare where we're at right now to where we were in 2008, 2009, we sort of got to this level of severe bearishness in 2008. It was actually about 6 to 8 months, if I remember right, before the eventual low, where you had 60% of the respondents saying they were bearish. That's way more than normal. So if we are in that position, that tells me that we're beginning to see the pattern of a bottoming process, but I have a checklist that I'm following, and I think 1 out of the 10 metrics are actually checked off as being bullish. So it's primarily very much still a bear market environment. So if you're an investor and you're looking longer term, I think what the question you want to ask yourself is, am I willing to accept the possibility of 10, 20, 30% haircut from this current moment to gain the benefit of 100, 200% down the road? And if the answer is yes, I could handle that, then I think you start to scale into some of the areas of the market that probably would be positioned well in a recovery phase. Things that are starting to show signs of strength, healthcare, things that have gone down a lot less than others. Funny enough, utilities, which is a fairly defensive sector, but on a relative basis, actually doing very well. And then I'd probably look into growth areas like technology, which again, if we are going to recover, that's where you would certainly see some of the renewed strength. But in general, the main way I would answer the question, Jared, in terms of where you want to be, it's areas of the market with improving relative strength, meaning they're doing better than other stocks out there. I think that's the most important technical indicator that is probably underutilized by individual investors.
I happen to like relative strength myself. I'd also note that when you see these huge, when we see these huge bear markets that are protracted, and we finally see the emergence on the other side, a lot of times you get a junk off the bottom rally where the stocks that have got beaten down the most rise the most, at least in the short term, because of short covering rallies. So that's another consideration there. So you talked about healthcare, you talked about tech potentially rebounding. I'm just wondering, and just kind of factoring in my comments about the junk off the bottom rally, tech is a very broad field. Looking at semiconductors, heavily cyclical, they've been battered. I'm wondering, are you screening for good balance sheets, strong balance sheets, some kind of other metrics? Because keeping in mind, we are still in a rising interest rate environment. Even if the Fed manages to put the kibosh on inflation right now, could be a persistent problem for some years.
It's absolutely true. And I think that's something that we have to remember is all of the macro challenges don't evaporate for any particular reason. I mean, a lot of these things that we're dealing with, we will be dealing with for quite some time, right? Rates don't go from 4 or 5% on the 10-year down to 1% again, and all of a sudden it's a very different environment. I think we're facing a higher interest rate environment for most likely quite some time. And if that's the case, you have to remember that one of the biggest tailwinds to the growth thesis most likely evaporates right at that point. I mean, those names are able to do well if rates are relatively low, which makes their future earnings seem a lot more attractive. If we are in a higher rate environment, it's an opportunity for the value side of things to perform pretty well. And just like the first 6 months of the year, energy was one of the better places to be, if not the best place to be, the only place to be in some ways. Materials, right? These are the names that did very, very well in that period. I think if we do start to recover, you'll see some excitement from growth. And I think it's some of the larger names, the stable names, the high quality names in the technology sector that I think would make a lot of sense to sort of nibble at. But I also think it's sticking with some of the value-oriented parts of the market that most likely are well positioned in a higher rate environment and actually can provide some further upside. Commodities have been struggling along with everything else, but you certainly get the sense that there's further upside to be had for energy once we work through the deterioration we've seen in crude oil prices.
Yes, and I think a lot of that has to do with the U.S. dollar, which has been weighing on so many things from commodities to equity, basically all risk markets. But you consider that WTI is priced in dollars around the world, crypto for that matter. As I like to say, the denominator in all crypto pairs is the U.S. dollar that we look at least right here. And so crypto has been having a tough time. Just wondering, because we talked about before the bond market might be in for a mean reversion, or at least some kind of turning point. I would think that the dollar would reverse at the same point too. Do you consider foreign exchange the same way that you do with the dollar, the same way that you do with bonds when you're looking at these various markets?
Yeah, so I've described the U.S. dollar as the wrecking ball for risk assets. And, someone was talking about, is anything going up right now? And the answer is, yeah, there's a couple of things, interest rates, but then the dollar. And the dollar has just been this incredible, beautiful uptrend, right? I mean, consistent push higher through the course of 2022 and really started last year. As long as the dollar continues to move higher at the pace that it is, again, it's hard to imagine that commodities can mount any sort of significant improvement, that cryptocurrencies could thrive. Gold prices, I mean, if you told me before 2022, inflation is going to be in many ways the story, I would immediately think buy gold, because that's sort of the traditional playbook. That's the classic inflation hedge. talk about one of the worst trades in 2022 has been gold. I mean, it just has not been able to do anything. And the reason is because the same thing, it's denominated in dollars. So the US dollar index, right, is actually overbought right now. And it's actually even more than that. It's what we call extremely overbought. And what that means is when you measure price momentum, it's kind of a Z-score if you know statistics. You're kind of standardizing the movements in a data series and trying to find extremes. The US dollar has been overbought for much of 2022, particularly on the moves higher, which basically means there's extreme upside momentum. When you become extremely overbought, which is where we're at right now, if you use the RSI indicator, it's an RSI above 80. We would always call that the good overbought. That means that it's gone so strongly to the upside, there's probably at least one more move higher. So it's sort of a short-term pullback, long-term still probably higher kind of thesis for the dollar. And again, that's one of those other things. You asked me how the S&P could continue to deteriorate and go down to 3,500, 3,200, which I think is an ultimate downside target for me. It's the dollar remaining strong that allows that most likely to happen.
Oh, 3,200. I've heard that figure out of a couple different names who I respect, and I have to consider that is a possibility here. I'm looking through. I want to go back to the Fidelity chart room. I think there's some really interesting stories that might have happened there, and that's part of this Yahoo Finance UnCut program is getting into a little personality and some of the history. You mentioned some names there. Anything in particular you might be able to share when you were in that war room or before, just in terms of some interesting anecdotes that might have gone on with some of history's legendary traders alongside you in that room? Some
of my most positive and also least positive experiences in the chart room were going around with the chairman of Fidelity, Edward Johnson III, who sadly passed away recently. He was a legend in the money management industry and literally turned Fidelity into the behemoth in the industry that it is now. Really, I mean, had an incredible foresight, and just the fact that you had a phone number you could call to get someone at your brokerage. That was the first time that had happened in the industry. You could write checks from your brokerage account. This is all this man that came up with some of those ideas. We used to walk around the chart room with him. We would get about little to no warning before impact. I'm talking about 10 to 15 minutes heads up. And it was the chairman's coming over. He was at 82 Devonshire, another building in Boston. We were at 100 Summer Street, right by South Station. And we would get the calls, like the red phone, ringing, and we pick it up. It's like, all right, all hands on deck. And I would go in. I'd usually grab one of my analysts, and we go in there. And those were the most intense hour and a half to 2 hour experiences in my life. My palms are sweating a little bit just thinking about these meetings because he was a walking encyclopedia of market history. This is someone who had run the Fidelity Magellan Fund, before Peter Lynch had. He had, a successful money manager, now was the chairman of the entire Fidelity family. And he would ask minute details about particular stocks, about mining companies, about supply and demand factors, about interest rate history, about different Fed chairmen, and obscure details like, can we find the one I will never forget, he wanted us to look up lobster prices to get a sense of more anecdotal supply and demand. We had to research the prices of haircuts because he had this idea that haircuts were one of, like the labor, the technology hadn't changed. It's still the same technology. So sort of like the Big Mac index can we create a haircut index. So literally we're calling the American Barber Association, trying to get 100+ year data series on haircuts and all of that. But it was great because it taught me a lot about the rigors of market analysis and just the intellectual curiosity that I found very much a part of the chart room. When we go around the chart room with some of those successful money managers, they asked really good questions. I went into there thinking they would know all the answers, but I found they didn't know all the answers. They just knew the questions to ask, and they asked really cutting, probing questions that made you think. So I feel like any independent intellectual thoughts I've had these days were born from those really painful and frustrating but wonderful meetings with the chairman of Fidelity.
Dave, what you're describing to me now is similar to what I listen to hedge fund traders Tell me, is some of their daily or weekly or quarterly meetings where they have to prove their theses, and sometimes several times throughout the day. And I just want to bring this to the attention of our audience here, because we're talking to retail investors for the most part, I would assume. And this is competition. Not that the stock market is all about competition, because a rising tide lifts all boats. But I would say in the short term, if you're a short-term trader, it's more of a zero-sum game, and you are up against some pretty stiff competition. So what do you say to some of the short-term to medium-term traders who might be new, might be a little bit old, but everybody's kind of experienced this type of market for the first time, unless you're a senior citizen, basically. So what do you say to some of these newer traders who are trying to navigate a very difficult environment, and a lot of people simply losing their shirts?
Yeah, so a number of things I would say. Number one, it's got to be a focus on risk management. I learned technical analysis in 2000 and 2001. That's when I was first introduced. That's when I joined the industry. And that's when I learned there was this toolkit to help you get inside the head of other investors. And I was completely hooked on that. But what I learned in 2000, 2001, the institutional investors I worked for that were really successful and able to navigate that period were the ones that recognized that 1999 and 2001 were very different years, very different dynamics, and the charts just looked different. The people that were sticking to what had worked were the ones that just got eaten up completely during that period. And obviously, it was 9/11. It was a challenging period by many definitions. But I think that was the one. I think the people that were able to stay centered during that periods were the ones that focused on the evidence of the markets. And I was taught in some ways by Ralph Acampora, who's a technical analyst at Prudential, at Knight Securities, at a number of places. And he always told me that analyzing the chart is the easy part. Actually doing what the charts tell you, that's the tough part. So the analysis is straightforward. You can read a book about that. But having the courage, having the discipline to actually follow through on what the markets are telling you back is incredibly important. And the last thing I would say, Jared, is to think in terms of probabilities, not certainties. I saw your discussion with Brian Shannon not too long ago, and he echoed. He's a great analyst, and he echoed and trader, and he echoed those that same sentiment. I think that's 100% true. What I learned working for institutional investors, for money managers, it was never about here's what's going to happen and why, which is what I hear a lot of individual investors do. Here's my thesis: I'm bullish Bitcoin. Anyone that refutes that is an idiot, and here's why. What an institutional investor does is you look at all the different spectrum of potential outcomes, right? There is a scenario where the S&P rips up to 5,000. I think that's incredibly unlikely, but it is theoretically possible. There's another scenario where the S&P goes down to 2,400, which I think is equally unlikely, but it's also possible. So I want to think about what would the conditions be if the market actually, for the market to actually do that. What asset classes, what equities, what sectors, what themes might thrive in those environments. And then when one of those outcomes actually happens, I'm prepared because I've already thought through it. I've thought through the bear playbook, through the bull playbook. And so I would encourage individuals to think about probabilities. On my YouTube channel, about once a quarter, I put an S&P video up there, and I say, here are the 4 different scenarios. Choose your own adventure. Which do you think is most likely and why? And it's less to predict it correctly, and it's more to force yourself to think about 4 different potential outcomes. I encourage people to think in terms of probabilities.
I love that analysis, and I love the framework there, because I think it's there's too many people selling snake oils on Twitter, on Twitter and other places. It's just, there's a lot of bad products out there, a lot of bad advice. One of my biggest filter is simply, do they have more than one scenario outlined, or they have a thesis. This is how I'm right. This is how I'm wrong. If I'm wrong, maybe consider this option. People who are just putting out one potentiality, one scenario, they're probably just trying to sell you a bill of goods. And then you mentioned, going through my notes here, S&P 500, 5,000, 2,000. What does that look like? Beautiful to gameplay these scenarios. What does it look like in some of these outlier events? What does it take us to get there? Not that we're trying to get people's hopes up or trying to get them down, but I'm just curious to see what it looks like in your mind.
Yeah, so when you think about those extreme scenarios, and again, one of the realities, if you read the like Black Swan and those other books, I mean, you have to remember there's the fat tail issue in the markets, right? It's any sort of market data is never a normal distribution, or rarely is. You have these extreme events that are much more common than a normal distribution would suggest. That just means we tend to have 3, 4, 5 standard deviation moments on both sides, to the upside and to the downside. So I've learned a long time ago, thinking of those extreme scenarios is good, because then you have the bookends. You sort of know what those outliers look like, and then you're much more prepared for a more moderate sort of middle of the road outcome, which a lot of times is where the market actually will net out. So what happens in a severe bearish scenario? I would argue it's more of the same. It's this acceptance phase that we've just maybe arrived at, persists for quite some time. It's more and more language from the Fed that we are nowhere near ending, which I would argue is part of what we're hearing now recently in the last week or two, right? They've had this last 75 basis point hike, and then all messaging from the Fed is we're not done, and we still have more to go to kind of get there. And now it's speculating where that eventual line is going to be. So that severe bear scenario would involve the macro conditions. The Fed has a lot more to do, continuing to pull liquidity out of the system. The market recognizes how difficult that is for any sort of growth stocks. Our benchmarks, which are very growth oriented, really start to struggle. And very quickly, you get into that fetal position mentally, where it's just, all right, now this is a deep downtrend, and you wait for deep value investors to come in. And again, I think 3,200 is a decent downside objective in that scenario. I don't know if we would get much below that before some really excited investors would start buying on size. The real bullish scenario, though, think about that as well. That's where we start to get the opposite. We start to get language that inflation, we get data that inflation is starting to dissipate. There's enough excitement. That's kind of what we got in June and July, was sort of this sort of mini rally. And it was driven, I think, by an expectation that the light at the end of the tunnel was very, very close. Now we're seeing it was a lot further out than we expected. But not just does the S&P rally to its 200-day moving average, it blows through it. Not just that stocks like Apple are bouncing up to their highs, but actually able to power through it. I think that was one of the great tells in August, was a lot of individual equities, a lot of sectors, instead of hitting resistance and breaking through, they hit resistance and then pulled right back. A bull market is driven by breakouts, and that's what you need to see to get anywhere above current levels that we're seeing now.
Yes, and I'd also add that a lot of those technical indicators like moving averages, those have slopes too, and the moving averages tended to be going that way. And when you have a stock that's coming up to meet a downsloping moving average, doesn't quite make it through, that's a pretty big bearish signal right there. You mentioned risk management before. I'd like to talk about this as part of the trader toolkit, something that's essential, because at the end of the day, when stocks go on sale, a lot of people don't have any money left in their account, and that's a huge issue for a lot of people sitting here. Now, if you do have some cash on the sideline, that's great. But how do you get to the position where you have where you've treated your account and your portfolio appropriately, and you've managed risk appropriately, so that you have these opportunities and you can play by them?
Yeah, risk management is so valuable. One of my great quotes is, "All large losses begin as small losses." And I think what you have to remember in any environment, hopefully, if you've managed risk effectively, 2022 has been relatively straightforward, because I feel like stocks have clearly broken what were most logical stops you could probably use. They've been broken, right? And if you just follow a simple money management strategy of making sure you minimize your losses, I think overall you probably navigated 2022 okay. The only way you can put a lot of money to work at the lows is if you've been raising cash on the way down, or earlier on in the cycle. And that's why I think, from a technical perspective, what I learned when I was first learning technical analysis in 2000 and 2001 was it was all about sort of a line in the sand, right? At what level do you agree to revisit a position? What level, what signal, what indicator needs to trigger, at which point you decide, no matter what you think might happen or could happen or you wish would happen, you get out and you cut your losses. And if you do that effectively on the way down, you have plenty ready to reallocate and put into the markets. Often, I think the most painful discussions I ever have with clients or with our own users is when they come after they've lost 20, 30%. They say, all right, I've owned this, it's down X percent, now what? And my answer is, go back to when you put the position on and have a much better exit strategy. I've spent a lot of time trying to fly airplanes. And what you learn as a student pilot is the time to figure out your exit strategy is not when the engine cuts out and you're going down. That is often too late to figure out a good exit plan. You're actually working on your exit plan when you're flying straight and level. You're flying at 6,000 feet, no clouds in the sky, everything's great, no turbulence. That's when you're scanning the ground, you're looking at your map and making sure you know what airport is where and what the wind is. So if something would happen, you can get the plane on the ground safely. And so I feel like the time to be figuring out the exit strategy is earlier on in the investment process than a lot of individual investors probably accommodate or plan for. And that's what's most frustrating in this environment is you're not ready. You don't have that cash to reallocate because you weren't raising cash appropriately on the way down.
And just quickly here, what should investors consider? Let's say they're in that position and they don't have enough cash on the sidelines. They've committed previous errors or faux pas when it comes to trading, and you're opening up your account statement or you're looking at charts and you're forced to look at these stocks that you've been in forever that you don't like anymore. You're just kind of praying, crossing your fingers that they're going to come back. Went down 90%, now realizing finally it's going to take a 900% rally to come back. Do you cut your losses, tax harvest? What kinds of things do you consider? Because it's different for every investor. What do you consider doing to ease the pain a little bit and set yourself up for success? Because now is the time to start thinking about success in the next bull leg.
So two ways I would answer that. And you hit on the tax implications. I think a lot of times when you've had that sort of issue, it needs to be a tax discussion more than anything. And I think that's where you really need to think about the possibility, the impact. One of the newer traders, I won't call them out on the air, but one of my contacts wrote me and said, hey, this sort of scenario where basically they did a bunch of selling and all of a sudden they got this huge tax bill and they really hadn't thought through the tax implications of this app on their phone that they were using to trade stocks, day to day. They didn't realize the impact that they were causing this huge financial headache for them. And when the bill came is when he wrote me and said, what do I do? And I'm like, well, the bad news is you just have to pay it and move on and have, this is a great lesson learned. So I think that's certainly my one discussion is work with a financial professional who can help you accommodate for that. Tax implications aside, I would argue it's never too late to make a good decision. And what I always tell people is it's always a good time to own good charts. What I do as part of my process is every day, and in particular every week, I scan for stocks with constructive patterns. And there tend to be some general things I will look for. I'll look for stocks making, new swing highs, meaning they've been in a downtrend, but they just start to turn higher. Certain indicators that can capture that trend reversal have just started to trigger. You're starting to see signs of accumulation, and there are indicators called accumulation distribution and others that we can use to analyze volume trends and see whether or not it feels like institutions are starting to accumulate those names. The relative strength is most important because that shows you that it's performing better than other names. I would never think it's a bad time to unwind positions that are not working and to layer into positions that are starting to show strong signs of accumulation. And if you can continue to do that consistently, right, sort of unwind the losing positions and rotate into the winning positions, overall, that's how you do well. Peter Lynch told me if you do the opposite, it's like watering your weeds and cutting your flowers down, right? You want to do the opposite. You want to water your flowers and cut the weeds. Make sure you're doing that with your portfolio. It's never too late to pull a weed that's really ruining your flower bed, I guess.
Peter Lynch advice there. I love that. So we've gotten some good advice from some market legends here. I'm just wondering any other interactions you've had. Could be in the Fidelity chart room. Could be anywhere else. Some household names that you could sprinkle into our conversation. Any words of wisdom there?
Yeah, one of my favorite analysts I used to meet with, John Roque, who's a legend in the technical analysis community for sure. He was at Natexis Blikre for a number of years and went to work at Tudor and a number of hedge funds in the New York area. John was legendary for his meetings because he was a huge baseball fan. And talk about the courage to be a New York Yankees fan coming up to Boston to a room full of Red Sox fans and pitching, Yankees philosophy to us. But one of my great discussions with him, we were talking about, and this was probably 2011, 2012, if I would guess the date. But we were talking about the market environment. This is obviously sort of still early on after the 2009 low, but still not, we're not sure that we're going to go to the moon yet. We didn't really anticipate the rally that you'd seen through 2020. So it was still sort of early on. We're still below the 2007 high, and it's a question mark as to what's going to happen next. And he said, all right, let's imagine you manage the New York Yankees and you come up to Boston and you want to beat the Red Sox. What are you going to do? Are you going to take your bench players who are kind of having in a slump and not doing very well? Are you going to put them on the field? Or are you going to put your rock star, power hitters, the A-Rods and whatever Yankee names he dropped on us at the time? Are you going to put those key players on the field? What's going to give you the best opportunity to win the game? And it's obvious that that's the answer. And his response is, why would you do anything different with your portfolio? I think a lot of times investors go into that wishful thinking hypothesis, which is, boy, this is down a lot, something like a Peloton, which is just one of the ugliest charts in the history of charting. And again, it may work beautifully, but that would be highly unlikely before. I mean, you will see signs that a name like that or Zoom or whatever those names that are sort of those emerging tech COVID names that have been struggling, one of the media names like Comcast in the severe downtrend, they could revert and go back to the moon tomorrow, but highly unlikely. And most likely you'll see signs along the way that conditions are starting to improve. So his comment was, if you're managing a baseball team, you put your best players on the field. If you're managing a portfolio, put your best stocks in the portfolio. And so that lesson of relative strength is one that I definitely took to heart. And it served me very well over my career to keep focusing on names that are doing better than other names. My last comment was from Tom Bowley, who runs a firm called Earnings Beats. And his comment is, if you want to outperform the S&P 500, you need to own stocks that are outperforming the S&P 500. So that's where I would be focused.
Yes, and to your point, I would point out that Cisco, as strong as it's been at various times, still has not taken out its dot-com bubble high. And by the way,
exactly
Citigroup is still at the bottom end of its range. If you look at a chart going back to the global financial crisis, not all of these stocks are going to come back. Speaking of things which may or may not come back, I think I'm going to give it away. I'm talking about crypto here because you said to the moon. I had these ideas about Dogecoin. We don't have to do technical analysis on that, but it's a huge new asset class, and it's very important to our readers. I own crypto as well. Bitcoin, kind of the leader here, along with Ethereum, but Bitcoin been stuck in a range between, let's say, 17,000, 18,000 and 25,000 for 3 or 4 months. Just your thoughts in general on the crypto space.
Yeah, it's a really good question. And full disclosure, I do own some cryptocurrencies. I own Bitcoin and Ethereum, and my logic, I own them in retirement accounts. My logic for owning things like that is the same reason why I own some cannabis stocks. They're not great charts. They're not great companies at the moment, but I'm buying into the long-term thesis, which is this is an emerging trend that evolves over time. And I would be surprised if any of those things I just mentioned don't appreciate at some time. And those are not things I'm trying to time, and I'm not trying to get cute. I'm just trying to buy into a long-term trend. Same reason why I think you would invest in clean energy in some way or artificial intelligence. These are themes that I think we'll be talking about for decades, not just for days or weeks. Having said that, I mean, I think the challenge for cryptocurrencies, it is very much an untested space. I would argue there's limited fundamental data. I mean, you can get data on mining, on supply and things like that. But overall, it's still very light relative to an equity where you get a ton of transparency and you have a company management that you can be talking to or reading their comments and sort of learning underneath the hood what's going on. Bitcoin and other, and certainly other less liquid cryptocurrencies are a petri dish for volatility and for behavioral biases. I think any sort of behavioral context that you see with equities are magnified by 100-fold. And you see that by the volatility, right? An average day in Bitcoin is way noisier than the average day for pick a random stock in the S&P 500. It's another level of magnitude higher. Having said that, I mean, I am a trend follower by trade. And so when I see the chart of Bitcoin, when I see it remaining below 20,000, it's hard for me to get too excited about the trend characteristics, sort of bounce off that 17,500 level. But at this point, sort of in that no man's land, not really able to mount any sort of recovery. At this point, they certainly feel more like risk assets than anything else. You don't see them as much of a hedge on for risk as people maybe expected going into 2022. I think they've mapped the overall sentiment of investors pretty widely. So having said that, Bitcoin above 20,000, I think it deserves some attention. Until then, I think it's still sort of potentially a long bottoming process with no near-term end in sight.
We've seen these crypto winters persist for years before, as we have with stocks. Yeah, we were talking about analogs where we have these long drawn out bear markets and stocks too. Got a few minutes left here, and I want to talk about investor education. Just any resources, any books that you look to, or that you provide yourself. You have a great mind in terms of technical analysis, so feel free to promote any sites that you have. But what are you looking at on a day-to-day basis, and who do you read?
Yeah, Jared, thanks so much. So my day job, I'm the Chief Market Strategist at StockCharts.com. So we focus on tools, education, and commentary. And education is a big part of that. We have a whole section of the website that's free called Chart School. And it's really meant to help empower investors to make better decisions. One of the great things about social media is, on Twitter and elsewhere, is you have people exchanging ideas. I think what it also brings to the forefront is there are a lot of people, I think, that could use a lot more education on how to use those tools consistently. And I think consistency is one of the big challenges for individual investors that they could probably improve on. What's your daily routine, your weekly routine, and so forth? What are you looking at? What information are you consuming, and how are you translating that into an investment decision? So with the education, the commentary parts of the StockCharts website, that's where we try to focus. We focus on your routines. We focus on what charts you should be looking at consistently, how you translate that into an investment process. And then my own website's called marketmisbehavior.com, and I have a YouTube channel with the same name. And that's meant really to help empower investors to minimize the impact of behavioral biases like confirmation bias, which I think runs rampant in the industry. What tools can you use to minimize those negative impacts and really have a consistent, disciplined approach to decision making? So I'd encourage people to check out my work there.
And on Twitter, I'm wondering who you like. And I assume it's going to be one of those people would be Helene Meisler. She still charts the old-fashioned way with paper, and sometimes she has to extend to the upside or the downside on another piece of paper. Who do you like on Twitter?
I was going to say, I love following the masters. And so, on Twitter, Helene is awesome. I mean, talk about one of the great, she's really a legend in the industry. I mean, one of the first technical analysts, probably the first pure technical analyst at Goldman Sachs back in the day before, others that came after her, and just old school, classic charting. And there's a lot to be said for that simplistic method of just hand drawing charts, which she shows frequently. Walter Deemer is another favorite of mine. He ran the technical research team at Putnam Investments in the 1970s. Getting a chance to ask someone who was actually analyzing the markets in 1973 and 1974, what did that feel like? What did you hear? What were you reading? I think that is fantastic. And the fact that you can access people like that on Twitter is pretty awesome. On top of that, I look to the old masters as much as possible. John Murphy, Martin Pring literally wrote the books on technical analysis. And if you can get your hands on something that they've written, I think you're in good shape.
Yep, Murphy, Pring, masters of so much in technical analysis, and a couple of my favorites as well. We got to leave it here, but we could easily go another hour or 50 minutes or an hour and 50 minutes. Really appreciate you stopping by here. Learned a lot. Check out Dave Keller at his website. Let me just get it here again. It was marketmisbehavior.com. Marketmisbehavior.com. All right. Also, the Chief Market Strategist over at StockCharts. Thank you for joining us. And thank you, audience, for tuning in yet again. We're going to be here with another guest someday. So stay tuned.